Right.
So, like today, one of them is.
Sure.
Yes, sir. We are live now on our YouTube. Yes, we'll begin now.
So we can begin now.
Yes, sir.
Right. So first of all, thank you everyone for and the coordinator especially for inviting me. Good to interact with students, and I think it's a two-way learning process. I get to learn what's trending now, what is something that you guys are excited about, and you get to know about the experiences so far in terms of corporate experiences. So yeah, having said that, I can the way I've thought about it, and like I mentioned to the coordinators earlier, sorry, I don't have a concrete presentation to kind of share with you guys. I had a very pressing week and really could not kind of work on a presentation to share with you. But having said that, the way I want to make it up is by being as exhaustive as possible around my own experience around how what analytics means in a banking environment, in a consulting environment, and then maybe talk about fintechs and the advent of fintechs and what exactly is how is going to impact the banking space. So I'll start with my own introduction, a bit more than what is there in the LinkedIn to kind of look at. I'm a graduate in electrical engineering from NIT. Post that, I had opportunities to join the core domain. I'm basically from electrical. I graduated in electrical engineering, but I choose to join Mu Sigma. Mu Sigma, as you guys know, and I saw that it's one of the recruiters here. Back then, it was a startup, so it was a very small company. But the experience has been great. Experience was great there. I joined, and you have this training universities in Mu Sigma, so you learn a lot of technical skills, and that's something that's very paramount for an analytics experience, because you need to be very well versed on skill on having technical skills like Python, R. That moment of time it was SAS, SPSS, VBA. A lot of technical knowledge is a prerequisite to have a good career in analytics. So Mu Sigma gave me a good platform that way. Quite hard in terms of your work-life balance there, but it was a good experience there. Then I made a shift to HSBC. HSBC, I was part of the modeling team. Again, the experience has been primarily into credit risk analytics, and when I talk about credit risk analytics, it's more around having those building those scoring models that are used to uh, help in acquiring new customers. You have capital models and so on and so forth. I'll touch that a bit more going on. But yeah, that's HSBC. I worked on the corporate side there, and then again you have this retail and corporate splits in terms of the domains. And HSBC, I was there for a period of 2 years before I moved to ANZ. And ANZ, again, the experience have been a little different. Again, within risk fraternity, right? So you have a lot of different teams that comes through. You have modeling, you have validation teams, you have monitoring teams, you have strategy teams, and so on and so forth. So once so I have been kind of explored. I have explored some of it already, and I intend to explore the other bits. But yeah, the experience has been primarily into predictive modeling and validation of the same models, stress testing models. So basically, a lot of models, I would say, a lot of statistics thrown in, a lot of modeling experience that I have. And currently in Moody's, it's a little broader map, because in consulting there is no defined projects. Like you get to work on say liquidity models, you can get to work on say economic capital models, a lot of different stuff. So I'm not sure if you guys have gone through Basel. Now within Basel, there's a lot of things that is required by banks to kind of be executed, and that's where a lot of work comes up. And outside of work, I would say it's I'm a professional chess player, and I'm a history and a sports buff. So that's pretty much about me, my experience. Now, the way I thought that I'll talk about is before the fintech, and before we come to the topic, I thought I'll just speak a little more about how it is in a banking world, right? How the analytics works. Even in places like Mu Sigma or a Fractal Analytics or Bridge I2I, I think it's one of the recruiters, I believe. So what exactly is expected? What are you looking at that in those companies is something that I thought I'll just kind of share my experience on. Feel free to kind of I know there is a question and answer Q&A at the end of it, but if you guys have any queries in between, anything that you want to ask, feel free to kind of jump in, because I feel that it's better to kind of deal with queries as and when it is, rather than having all of them kind of stacked up at the end. Right. So in terms of the banking analytics or the predictive analytics that we talk about, now, the reason I talked about Basel is because Basel is like the underlying theme, right? So that's the guidelines around which the banks operate, and especially after the financial crisis, there's a lot of impetus on the capital that we keep aside, the kind of provisions you keep aside, a lot of focus on how much the banks should be regulated, right? So there's a lot of focus there. Now, what it entails is that the banks need to be much more prudent in terms of determining of keeping aside capital, so that's something that helps them during the time of stress. They also need to have provisions. They need to have those stress testing models come into picture. Stress testing is basically you stress the scenarios under which you operate, and then determine how much additional capital or money you should set aside. So those bits. So the guidelines have been, now the guidelines also suggested that the regulators, when we talk about regulators in India, it's like RBI, in Australia that's APRA. You have those regulatory bodies which kind of help you execute those guidelines, right? And what it entailed was that these regulators will ask you to say, you have say 100 million as your portfolio, they will ask you to keep aside say 40 million based on their calculations. Now, where banks are trying to build in models and where we come into picture is the banks are saying that why would we take regulators' observations as it is? Why don't we build models that will help us determine those capital at the first place? So that's where the whole concept of modeling and that entire framework of modeling, validation, you have strategy teams coming into picture. If there would have been no Basel, there would have been no such thing. We would have been out of jobs, and we would not have been discussing all this. So, the other part of it, where and more important part of it is around acquisitions. Right, I talked about the capital side. That's more driven by Basel, but Basel doesn't tell you which customers to acquire, what to do with the customers, how much should you lend, what price should you target in terms of the product. Those bits Basel is not bothered about. Basel is just saying about capital, and it's talking about provisions. It talks about stress testing. It talks about having those internal regulatory oversights, and you need to have models for that, and that's what I was talking about. The other bit is around acquiring customers, around building models so that you are able to understand what kind of customers you need, how much of it can go wrong. And that's the other part we call scoring, or the acquisition scorecards, the behavior scorecards. And in those, the focus is very different. Here you are looking at, you don't look at customers per se in capital models. You look at how you look at the overall portfolios and try to build models on that. Here you look at individual customers, you look at how to model each customer, and it's a very different kind of modeling that's placed. But that's also where we get engaged. That's where a part of your credit risk analytics is. Um, so you guys have any question in terms of my pace? You want me to slow down? Any issues as such right now?
No, no, sir. I believe we are going good.
Sure. Yeah. So when I talk about scoring, and I believe you have those courses in your curriculum as well, predictive modeling and so on, and advanced statistical methods. Those are what is useful in kind of building those models. And I can give you an example just to kind of illustrate what we do. For example, say Axis Bank. I'll talk in Indian context, but my experience has been pretty much more European than Indian. But I would talk about an Indian bank context, how exactly this models come into picture, right? For example, Axis Bank is creating a credit card, right? Now, Axis Bank wants to know what kind of customers it should target so that the profitability is maximum, right? Now that's where the segmentation comes into the picture. What kind of customer should I target? And that is where there is something called as a marketing analytics. That's a different division of a bank. These guys, what they do marketing models. They try to understand what kind of how to target customers, how to get customers on board, right? And there's a lot of segmentation that is done. What is segmentation? Basically, any way where I can have a much more granular concentration of customers I can target, because if I target everyone, I may not get much use. I would not it won't be helpful. So once I have customers in place, and once now the whole objective and where we have in the past built models is how do I evaluate each customer, or its willingness to pay, its ability to pay, and how should I grade it based on other customers. And what I do is, so for example, Axis Bank has decided that it will pay, it will only look at giving a credit card for people less than 40 years of age, right? Now that's the first bit, like looking at 40 years of age. We have a population now. Now what we do is we look at the past data. Now Axis Bank in the past would have either co-branded credit cards, might have its own credit cards, which were like an earlier generation credit cards, and would have some data around it. Then the idea is to kind of build a scorecard on those bits and those data points, and try to kind of see if and when we talk about data again, like you would have I believe done some kind of data projects on this, is that you look at data, you look at cleaning, you look at what kind of variables you look at. And that's a very important aspect, right? What kind of variables should we have, whether credit utilization is the right variable, whether age is the right parameter to look at. There are a lot of variables that we look at. Now, a lot of data cleaning happens, a lot of variable screening happens, and you have a lot of statistical methods of doing that. And that's where your background in statistics is important, right? Anything and everything that you are doing in terms of determining a particular variable, whether it's insightful, whether you want to have a kind of a variable selection process, whether you want to kind of remove correlated variables as in variables which have very high which are very close to each other in terms of the information they have. You have a lot of statistical methods, like you have and that's where your learning of statistics becomes very important, because anything and everything you build, you have to justify it statistically, right? And like I said, for example, I look at collinearity in my model. I look at multicollinearity. Now, multicollinearity is a concept in itself. When you look at regressions, you look at multicollinearity. Those bits. What I want to stress on the fact is that a lot of statistics is applied in building a model. So if when you're learning all this, try to think in that perspective. Why would I use this test? I believe you would be learning a lot of tests. Why do you use it, and when should I apply it to get something that will help me in kind of deciding whether this variable is right or whether this data is fit for the model. See, but the whole idea is that for each kind of variable, for each kind of model, say credit cards, personal loans, you have different variables, right, to choose from. And once you have those variables, you are able to select, you put them in a regression model, and you look at your dependent variable, you look at what kind of, it's a 1-0, whether you're determining the ability, whether it will pay or not, whether it will default or not. And you build a logistic regression. Then the whole idea, again, where the statistics comes into picture, is you have to prove that your model is good, right? You have to prove it to the regulators, you have to prove it internally to the senior stakeholders. Now, how do you prove it? You have a lot of statistical measures, right? You have, say, Hoshmo-Lemeshow test to show that your regression is fitting rightly. You talk about Gini, that's a discrimination, that whether the model is able to discriminate between a default and non-default. You have confusion matrices and so on and so forth. So a lot of things that is used there, and a lot of statistics put in, right? And once you build the model, again, you have to validate it. When I talk about validating, what exactly comes into picture is that you have this model that the modelers have built. They have used certain methodology in building this model. Like, for example, they said that, okay, out of 150 variables that we got, we removed 20 variables because they had no information. They had basically no data for us to kind of understand. We removed 30 variables because they were like having very low information value. Again, information value is like a measure to understand how much of information your variable carries. You have a formula for that, but you have to understand the reason behind it. So that's a way of removing variables. Then they would have other logics to kind of prune that variable list from 150 to say 20. Now, what a validator does is to understand whether that 150 to 20 variables that were finally used for the model, whether they are right? Whether they are justified, whether there could have been anything else that they overlooked. And that's where the validation within a risk framework comes into picture. So you have a modeling team which looks at developing models. You have a validation team which looks at validating models, and they also have certain statistical techniques to kind of evaluate the model. And before this, you have a methodology team and a risk strategy team. Now, what these two guys do is, the strategy team is, say, like I talked about Axis Bank credit cards, right? The strategy team, what it will do is it will talk with the business to understand what do they want. Like, see, the business guys, right? And this is something that I want to kind of share. When you are talking about analytics a lot into statistics, a lot into data, a lot into insights, but statistics will and a lot of analytics will only help the business. It's the business that will come to you to tell you that, okay, I want to have a credit cards for, I want to develop new credit cards for this, for the Indian population. And based on segmentation, we found that it is less than 40 years of age. Can you build us a model, right? And they will tell us that we would go aggressive, but they don't understand the risk behind it. They will not care about the risk. They will just say, I want to be aggressive. I want to give it to everyone and anyone who is less than 40 years of age and willing to take my credit card. So that's the business for you. That's the guys in the business who are more of product managers, more of guys who think about getting new products into the space. That's what. But once the risk team comes into picture, the risk strategy team, those guys, the primary objective is to tell them that, okay, fine, we are okay with your aggressiveness, but we cannot afford more than, say, 10% of the customers going wrong or defaulting. That's where the risk strategy team comes into picture. They talk with the business and say, right, you guys want to go aggressive, we don't, but let there be a mandate that we will have, say, max 10% of the customers going wrong. So that's 10% of the customers defaulting, and which is more or less like, say, you have a Out of 100 customers, 10 customers are defaulting, 90 are good, which will pay you back. They will give you the money back. 10 will be delinquent. You will have to kind of do collections, recoveries to kind of get money from them. That's the thought. Once this thought is put by the risk strategy team, they go back to this methodology team. Now, what methodology team does is these guys are purely researchers, PhD guys. They would not know how to execute a model, but they understand the underpinnings in terms of the methodology. Like, for example, logistic regression should I use, or should I use a this doesn't look like a logistic. The output looks like a binomial. Should I use a binomial? Should I do any other kind of modeling techniques? What would benefit? So that is the methodology team, right? So I'm giving you a background in terms of the risk framework, the overall framework, and the way business happens. And this methodology team then talks with the modeling team to understand, can we execute this logic or the methodology that we have? Because the modeling team will have to execute the methodology to generate the results, right? And that's where you have the strategy team talking to methodology team and strategy team talking to modeling team, because all these three will kind of decide what kind of model come into picture, whether we are achieving the default rate that we are talking about, whether we are able to kind of build a model that will predict, say, 90 out of 100 customers as correctly. So that's the whole idea. And then you have validation teams and monitoring teams. Validation teams, which will, like I mentioned, look at your data and review and see whether it's right or not. And you have monitoring teams, which will look at once the models get implemented in the system and they are running, right? They will run. They have generally a time period of 5 years. They have to see whether it's running fine. That's what the the monitoring team does. So more or less, this is exactly how the overall framework is built. You guys want me to kind of talk more on the modeling process itself, or do you want me to go a little, say, look at it from a 20,000 leagues above and talk to you about? Because I can go and talk about a little more on the modeling that's done.
Modeling process.
The modeling process.
Okay.
Sure enough. So in terms of the modeling process, I think the most important bit is the data. Because if you have good data, you can have good models. If you have very bad data, you don't know basically how the front line has kind of put in the numbers. I'll give you an example. Like in India, when you go for a credit card, they ask you an application form, right? You fill a lot of things. Now, what if this application form is not verified? What if the guys at the front end, the operation guys, would just update the information you have shared and put it in the system, right? When the backend guys, the ones who build the models, look at this data, it will have 999999 as your phone number. Say your credit utilization would be minus 500. The reason I'm telling you this is that the most important bit, which I feel in a modeling, is not the technique itself, it's the data. And a lot of times what problem we face is that the operation guys, the guys who will be kind of updating the customer information in the system, right? They update information that's not something that's validated, that's not very clean. So a lot of times we lose a lot of information there. So whenever you build a model, I think you should spend around 40 to 50% on the time on data cleaning itself. Understand each row, understand your columns, understand what kind of variables you're getting it, the interpretability of the variables, the number of missing values. And if you have missing values and those variables are important, what should I do about those missing values? Outlier treatment, like women outliers, also looking at those. A lot of impetus should be given on data, right? And this is something that I keep on telling to my team also, and that we are very fussy about what techniques we apply, especially around, say, the machine learning has come into picture. I have guys coming to me say, Abhishek, I don't want to apply decision tree, I want to apply this, I want to apply that, and I am generating this kind of results and all that. But it doesn't matter what techniques you have as long as your data is right? If your data is wrong, if the interpretability is wrong, if your data is giving you confusing results in terms of its significance, then no matter how good your technique is, you will not get a good model. So yeah, so that's one bit that I want to kind of touch on, that when you talk about modeling, the model building process, a lot of is on data. We look at data a lot, and once we have a clean data, then we go into variables. And variables are important because that's are the factors, right? So tomorrow when you look at your CIBIL score, right? CIBIL score is a kind of a model that has been built, right? And it would have in the backend a certain bit of parameters on which you would have been scored, so that your total score is like a sum of this parameter, sum of individual factors, right? So, but those factors are very important to kind of understand that, okay, which factor should I take? Which factors are the most significant? And believe me, in a modeling, in a modeling world, right? Especially the models that are built and are validated and I've looked at, it is not very difficult. There's not a lot of different iterative methods around it. The methods are the process is pretty similar. What changes is the variables, like a credit card, a personal loan, a mortgages. Vis-a-vis, say, if I look at the corporate side, when you're evaluating, say, someone like Tata Sons, and when you're evaluating someone like, say, Vaibhav as an individual, right, the parameters will be very different. It is the variables that you need to be acquainted about, not the process would not change. Like if I have to talk about the process, I can tell you on the back of my mind that, okay, first you look at data, you clean it, then you look at your default definition. What is default definition? You look at, say, how do you define your bads, right? That's all about it, bad or goods. Now you define your default definition. Once you define your default definition, you define your data time periods, what data you're looking at, what time period you will look at. For your data, what time period you look at to validate the data. That's the time period that you look at. Once you have that, you look at the variables. You might come up with 100 variables, but you will find that eventually 30 of them make sense or 20 of them make sense. Then once you have those 20 variables, you will look at you run them. You find that, okay, there's a lot of collinearity, which is kind of making those coefficients fuzzy. You might have overfitting. That might happen, that you build it on a sample, it fits completely. But when you fit on another say test environment, it doesn't fit well. So that's overfitting that's happening. That might happen. But this process are more or less similar for every kind of model you build. What I mean to say is that this processes won't change. For every model, you will look at, say, the data cleaning first. You look at the default definition second, the variable selection, rather the time periods third, the variable selection fourth, then finally the fitting of the model and all that as 5. This parameter, this processes won't change. What would change is within that 100 variables that you initially had, right? Your ability to choose the right variables and your understanding of those variables, right? Because if you understand the variables, for example, I'll ask you guys, say debt to equity ratio, right? I'm talking about a corporate customer. It's an open question. What if how should what should be the relationship between debt to equity ratio versus say the default? When I say default, is that just whether it should be a positive relationship or a negative relationship? You just tell me.
It would be proportional relationship between the two.
Sorry,
directly proportional.
Directly proportional.
Yes, sir. Higher the debt, higher the
right
risk.
Yeah, higher the debt, higher the. Now, what if I give you a ratio like, say, growth, percentage growth? What kind of relationship do you infer with and they say the default percentage growth, as in percentage growth every year? If I have to say sales growth every year, what do you think? What kind of relationship?
Inversely proportional.
Inversely proportional.
Yes.
Sorry. Right.
Yes, sir.
Why?
Yes,
Why
sir,
do you
inversely
think,
proportional.
Why do you think so?
Because, sir, if there is economic financial growth in his account, then it is most likely that he will pay his debts, and so lesser risk.
Okay. But what if your data shows that it's a U-shaped, right? So you got your relationship, right? You understood what relationship, but your data, when you looked at your corporate data, when you looked at your wholesale data, you found that it's a U-shaped. Should we keep the variable or should we remove it? Right. So see, it's there's no right or wrong here. But what I wanted to kind of share with you is that this kind of things will be the challenge, right? What I feel is the people that have recruited from say IITs and all, they are very much focused on the modeling techniques. They are like fussy about machine learning. They're fussy about a lot of deep learning techniques, a lot of stuff, but they don't look at variables in general. They don't think about how the data is showing you signs, whether you are able to interpret the data in the right way. Like I said, sales growth, why I took this example is in one of the recent models that we built for one of the clients, this gave us a U-shaped curve, but the client was henpecked in having this variable in the model, right? So what I had to do is go back and understand from other similarly sized companies whether this is something that is natural or it happens, or whether it's not something that is, because I have to justify this, right? So this is something that I need to justify. So that's where I say that this is a challenge. And as you build models, as you look at data, the interpretability, that's one thing that you have to. And coming to the techniques again, see, a lot of existing techniques around logistic. That's the kind of bread and butter, because what we do is we predict it's 1 or 0, 1 or 0. We have some linear regression models. We have some complex version of models, but a lot of it is logistic at this point of time. Going forward, yes, we are experimenting with machine learning techniques, and there's a lot of impetus in kind of having models which would give you a higher discriminative power. Discriminative power as in the ability to differentiate between good and bad, right? You guys have read about Gini, GINI?
Sir, in decision tree, Gini index.
Gini index in a decision tree is there, but in Gini in general, do you understand the concept of Gini? From an poverty perspective, you would have read the world poverty is they talk about in terms of a Gini index, which is different from the decision tree Gini index. That's
basically a measure of inequality.
Yes, exactly. Income
it's also used in logistic modeling to basically as a measure of different power of basically our model. I mean, how good it is in differentiating between zeros and ones.
Right.
So we need the higher the resolution power.
Right. And that's very important, because that's what would differentiate, right? If you go and build a model, say using logistic regression vis-a-vis any machine learning technique, you have to show me that whether its discriminative power is better, whether it's able to kind of discriminate better, whether its predictive power is better or not. So that's what I'm focused on, right? So yeah, so I think this is a preliminary. The process, like I mentioned, right, the process doesn't change a lot. You can pretty much kind of scribble it down here, and if you once you go to the corporate and start working in a credit risk analytics work, you will understand that the process eventually is similar. It's just that techniques at one end and say the variable interpretability at the other end is what drives your models, right? So you guys have any specific questions, anything that you want me to kind of put in, or I can talk about where I feel fintechs are making a lot of challenges to the existing environment that we are in.
Sir, the students will keep posting the questions in the chat window if they have any. Otherwise, we will have a Q&A in the end.
Sure then. Sure. Then I think moving on to the topic, I think I'll give a little insights on why fintech and why this topic around. I think as you move out of your as you move into the job world, right, you will find that there's a lot of companies which are kind of coming up, startups, and you have say MoneyTap. You have a lot of those startups which are like revolutionizing the banking world. Why I say revolutionizing is because as a bank, right, I didn't really Sure. I think as a bank, we didn't care about micro segmentation, right? We did segmentation. For example, once I give a personal loan, right? I don't again look at personal loans and try to micro segment into someone needing a personal loan for 15 days and needing it for 45 days or needing it for 3 months and so on and so forth. If I have a personal loan, banks generally you would have seen, right? Any banks, the way they give loans, they're very staid. They don't do a lot of micro segmentation in terms of understanding the needs, in terms of personalizing this experience. That okay, I need a short-term loan of 5,000 rupees in 20 days. I don't need a 1 lakh loan, but if I go to an ICICI bank, it will say no, I have nothing less than 50,000 rupees. But I don't need a 50,000 rupees. I need a 5,000 rupees for 20 days, right? So what fintechs are doing actually are hitting at two major bits, the way I look at it. One is at the acquisition channels, like how you are getting the customers, the kind of experience, the customer experience you have. And the other bit is underwriting. Underwriting, what I mean is how do you decision the customers, what kind of models and so on and so forth. So that's the underwriting bit. The acquisition is the other bit. Acquisition channels, when you talk about, see, a traditional channel is a branch, right? A lot of you guys would have gone to a branch. I go to a branch for a lot of my financial needs. But what these guys are hitting or looking at targeting is in kind of having this personalized experience, and they are changing the way the banks need to work in terms of reaching out to customers. Earlier, branch was a great way to kind of connect with the customers, but not anymore, right? So acquisition channels are changing. The traditional channels through which customers used to come to the banks, they have changed. The fintechs have changed that. One thing that I would like to highlight over here is that in a banking book, right? In a banking book, can you name some of the portfolios that a bank has? Like mortgage is an example. Can you give me a few other examples of what portfolios a bank has?
Is securities, sir? No.
Okay. Okay. Let me be a little more credit portfolios.
So you mean stocks, bonds, ETFs?
No, when I talk about credit portfolios, I talk about mortgages. I talk about credit cards, right? So those are the kind of portfolios I'm targeting. Say, so any other examples you guys have, you can think of?
Is FD, sir, one of them, not fixed deposits?
FD would come under the bird. So actually, the way a banking book is more looked at is, or a credit lending book is looked at is, and I'm talking from, say, the lowest in size, the highest in volume, to highest in size and lowest in volume. That's the order I'm going. You have the smallest ones, smallest in terms of your revenue, and highest in terms of volumes are your unsecured portfolio. Unsecured portfolio, when we talk about, it's the credit cards, the personal loans, right? Those are like very low in terms of their impact if things go wrong, but very high in terms of volumes. Like you will have personal loans for, say, at least say 10 lakhs or 15 lakhs, but not, it won't be that impactful if you lose few customers in and there. Now, once you have this unsecured, then you move up to, say, a little more in terms of is that your mortgages you have. Mortgages, home loans. That's the other portfolio you have. Then you move into SME. SME is like small and medium enterprises. You have, any of you dabble in stock markets? So in case you do, right, you have those high, large market capitalization, the mid capitalization, and the small ones. Very small companies which have a lower turnover and all that. A lot of it comes to retail as well, right? There are thresholds. So that is called a small and medium enterprises. So that's another portfolio that banks have. Then you have medium enterprises. Those are like corporate customers. Now, when I talk about unsecured lending, when I talk about say mortgages, when I talk about SME, they're mostly retail individual persons. When I talk about medium MME, middle market kind of enterprises, which have turnover say 2 to 5 million, I'm just putting up numbers, okay? But those will be like middle markets, and they will come into corporate wholesale customers. They are not individual customers. They will have financial statements, they will have cash flows, they will have you will have to look at different ratios altogether. Like I asked, debt to equity ratio, you'll have a lot of financial statements coming into picture. The evaluation is very different. So those are your corporate customers. So MME is one. Then you will have the large corporates. Those are like the Tatas and Birlas and all that. They will have very high turnovers, very few of numbers. For example, in India, you might have 20 or 25, but one of them goes bad, right? And Yes Bank, for example, right? Yes Bank is a good example of that. Yes Bank, your large and middle customers, right? Mid-market and large customers. Few of them failed. Yes Bank went down. You had Kingfisher going down. You had few banks going down because of Kingfisher. Why? Because those are very large accounts, very large exposures, and you have very few volumes, right? The reason I told you this portfolio is because fintechs will not impact every bit of it right now. They cannot. Fintechs don't have the ability to go and ask Tata and Birlas to kind of take money from them. They will not be able to impact those big fish. What they're impacting is at the lower end of the spectrum, the unsecured lending, personal loans, credit cards, and a bit of SME, small and medium enterprise. That's where they're targeting. They're not targeting the middle markets, the large corporates. And the reason I told you this is something that when you read about Kingfishers, and when you read about, say, the need of Modis, and you read about why the banks are going down, this is the reason, right? These are the big ones. The big fish is always the one which will create a lot of problems in a bank. But fintechs will impact the lower end of the spectrum at this point of time. They don't have the money or the ability to kind of reach out to very big customers. So that's one area that we need to understand, that where will fintech impact the current banking bank lending book, right? Which portfolios it will impact. It will impact the retail, the unsecured lending. That's one bit. The second bit, like I talked about acquisition channels, why fintechs are making a lot of difference. You don't need to go to an ATM. You don't need to go to a branch. You have phone pays. You have a lot of things that you are revolutionizing the way we are looking at banks, right? You do fixed deposit at home, right? You don't go to a branch. My father still has those papers which shows fixed deposit, right? But I don't go to a branch to do fixed deposit, right? I do at home. So fintechs, what they're doing is they're changing the customer experience now, and then that's one area in terms of the acquisition channels that they have really impacted. The other area is the underwriting, right? In terms of the modeling. Now, underwriting, the modeling, what they have tried to do is that they're not looking at the standard data that we have. So in a banking world, right? If someone has to tell me that you are building a corporate scorecard, I know that, okay, I have to build a scorecard where there will be a lot of financial issues. There will be a bit of no personal statements as such, but I know about my ratios. But what if you bring in alternate data like Facebook data, and they're looking at alternate mediums to kind of acquire. So they are trying to build alternate lending models. They will not look at your standard variables, right? They will not look at say your credit utilization. They will not look at your say the number of days past due in a particular credit card. They will not look at all that. They will look at your Facebook. They will look at other sources to get those information. So they are revolutionizing the way the data, they're looking at the data and also the techniques used. Now they are looking at machine learning, and this again, there's a problem there. I'll tell you the problem. This is something that I've seen firsthand, is while they are talking about applying a lot of techniques, right? They are still in an unregulated environment. When I'm saying unregulated is they don't need to go to RBI to kind of approve their models, right? The moment they go there, they won't get approved, because regulators are people who have like 30 years of banking experience, right? They care two hoots about your modeling techniques. They don't even understand that. They just look at the results and understand whether I can actually sense, okay, this model is making sense. It is doing the things right or not. So they don't understand anything else. So that's a problem that fintechs have. Even though they're talking about alternate lending models, they're still unregulated, right? And that the reason they're unregulated is because they're looking at unsecured lending. Personal loans, RBI is not concerned about. RBI will be concerned about if you build such a scorecard for such a model for, say, your very big customers, like say Jindal, right? That is where they will be concerned, that whether you are using a machine learning technique and no one understands what's coming out of it. So regulators will never approve it. But they are suggesting alternate data, alternate modeling techniques, and that's why they're impacting the underwriting bit, right? So I talked about acquisition channels and the underwriting. The issue I feel is that and this is something that you guys need to be aware, is that the cost of funding, right? You understand the difference between, say, why banks are able to lend at the rate they do, but not the NBFCs. Do you know the difference in terms of the lending rates that currently exist in the market? Any of you guys have bought a home loan yet? I think you're too young to get trapped in that. But I would tell you that, yeah.
So basically, it's the trust which the bank people have on bank, and NBFC do provide uncollateral. I mean, without collateral, and the banks. I mean, to the susceptible customers which are not able to get lending from banks, do go to NBFCs at higher rates.
And the reason, yes, totally right. But why the higher rate? See, my point is why they cannot give a lower rates.
Sir, if may I, sir, the NBFC get loans do not from the regular customers, but bank can go to the regular customer through deposits, and they can ask for deposits. So the source of fund for banks are mainly the FDs and the saving deposits. But for NBFC, they have to lend their source of fund from the bank. So there's a markup on the cost of capital to be at the very start.
Exactly. And now think about fintechs. Now you cannot give rates like 6% or 7% or 8% at that rate. The fintechs will have to have a higher rates because the cost of funds, the rate at which they get funds will be higher, right? They will not have so once they have those the investors' money in, the additional money they need will always come at a very higher rate. So they will lend at a higher rate. Now, why will someone go to a fintech when I can go to a bank at a lower rate, right? So my point is that there are ifs and buts. It's not that, and fintechs have been really beneficial because I have seen it in my previous organization that the way, at least the turnaround time, right? The application turnaround time used to happen. There was a lot of push from the higher management to kind of turn around those credit card applications, the personal loan applications. The models need to decision faster. And by faster, I mean is that they have to be built in such a way that your decision-making process is smoother and quicker. You are able to tell whether we want to give it or not. This didn't happen earlier. This impetus happened because fintechs have come into picture. They're turning around personal loan applications in, say, half a day. The banks take 2 days. But a guy like me or you who is short of time will take a fintech and say, okay, lend me this. I'm okay with the higher rates, but I just need my money today, right? So there are bits where fintechs have really pushed in. They have changed the way the channels are. A lot of banks are closing down branches. They are looking at micro segmentation. Now, a lot of impetus has been given in banks to kind of create product managers who can look at a particular segment, say a mortgage, and then think about how to further make it granular, for make it more personalized for the customer. So that has happened because of fintechs. A lot of impetus have been put into infrastructure. Like I told, the turnaround time for applications, the data systems, you should be connected in a bank, right? In a bank like HSBC, it's the data servers are like huge, and we have so much data lying at so many different bits which are not connecting to each other all the time. There is a lot of move around. So the process, the application process is very slow. So that's something that fintechs are pushing in, and that's where there is a lot of changes that is foreseen. Though these are the good changes, but I don't think fintechs will survive by themselves alone. They need something that something like a bank to kind of move ahead. And I believe, and this is my kind of a closing statement, that going forward, fintechs will not act as a foe for the bank. It would be more of a collaborator. And you will see a lot of banks working with fintechs to kind of improve their systems. But fintechs taking over banks, I don't foresee that. Like banks being seized, banks not existing in the future, that I don't foresee. So yeah, so that's my observations around fintech. Sorry if it has been like kind of a huge run, because like I said, could not create a presentation which could have made perhaps a little more structured. But having said that, I wanted to share observations that are very true to me in terms of my experience and something that I've seen so far. Right. So open for you guys to kind of.
Thank you, sir. Thank you very much. That gives a lot of insights to all the students, and I believe that everyone had a very good takeaway from it. So we will begin with the Q&A session now. So we have first question from Swan, that like you said, there is a lot of importance should be given to understand the data rather than the modeling technique. So he wants to know, in the scenario of a bank, do they take the business decision like financial crisis of 2008 or COVID situation last year? Most of the past data would not have made much sense to them. So in such a scenario, how will the decision be made?
It's a great question. I think this is a question that we are asking ourselves inside the organization. This is something that our clients are asking us, that fine, you have given us models that work well under scenarios, but what if something like COVID comes into picture? See, these are predictive models, are not supposed to be like very accurate. But what they have done is we have kind of done a lot of scenario analysis, a lot of and when we talk about scenario analysis, we do take into past events like 2008 crisis, right? I'll give you an example. In Australia, there is no financial crisis in 2008. It didn't have it. It had last in 1991. But what they do as a best practice is to kind of infer data from US, because US where the recessions happened, right? A lot of macroeconomic variables, a lot of variables that are useful from the US economy. We look at it. We try to see perhaps a correlation, or perhaps some common grounds to kind of use those variables in our models to kind of create scenarios for the future. Now, whether this would be completely useful in a COVID scenario, no, I don't think so, because like this is unprecedented, right? And moreover, the COVID impact would be seen now, because during the COVID, right, you still look at lag data, but its impact would come now. And to your point, see, it would not completely kind of negate it. That's for sure. COVID impact cannot be completely captured. It's unprecedented that way. And but financial crisis 2008 has been incorporated. That's for sure. Any modeling that happens, especially around those regulatory models, because for your acquisition scorecards, for the scorecards that are used to kind of get customers into the bank, you don't need all this. But for capital models, the regulatory models where you actually use, we do incorporate financial crisis. Downturn scenarios, we call them downturn scenarios. They are included in your modeling.
Sure.
Does that answer your question?
Yes.
Next, we have a question from Sarim. Sarim, you can go ahead.
Yes, sir. So my question is that regarding the credit card models. Suppose we are taking the objective here is to generate a list of customers who are have a good CIBIL score, but these set of customers are not going to being in default, and they are not going to pay up the bank default charges. So how the balance means they are not going to generate profit. So how the balance is going to be maintained between profitability and at the same time the default risk?
Good. Again, a good insightful question. See, this is perhaps the risk to reward ratio, right? You will have some defaults, but you will still have to. When you talk about pricing of a credit card, right? When we talk about, say, anything, when you talk about your mortgages, when you talk about your home loans, your car loans, there is a pricing involved, right? At certain rates, they give it so that it's optimum, right? They take into account the number of defaults that traditionally should have. Now, having said that, it's not that defaults are always very loss-making for cards, because there's something called recovery and collections, right? And there's a lot of models in there as well. Collections, what they do is, the moment you default, a default in a bank's parlance, the way we call it, is a 90 days default, right? 90 days past due. But what collections teams start doing is, after 30 days you have gone delinquent, you have not paid for 30 days, they start looking at you. They start looking at you and see whether there is a propensity for you to go to the defaults. Now, by 60 days, they have already started a recovery process. What they try to do is try to get some dues back, see if they can get something back. If nothing else, they will stop your drawdowns. Basically, you cannot draw down anymore. So generally what happens is, generally the data that we have seen is, a guy, before it goes to default at 90 days, starts pulling up more balance or spending more in around the 60 to 90 days again. That's a cycle we've seen in the past. So that's something that we stop. They don't allow it. And some bits, what happens is that the customer has gone default, but because of, for example, a COVID scenario, right? He's willing to pay back with some charges and all that. So you don't generally lose everything of it. But having said that, any model that is built, right? It's built with and once you put a threshold. For example, you talked about CIBIL score, right? I'll just give you an insight quickly. For example, a CIBIL score of 660, right? That for Axis Bank is good enough. How does it come to 660 as a good enough? What it has done is, here it has looked at its past data. Guys with less than so it has found that if I have a 660 score and above, my profitability is optimum, is enough, right? Say 660 is the threshold below which I will not take any customers because they're not profitable. 660 and above, usually I get 4 out of 100 bad, and I can live with it. So that's the threshold that they have decided. They will go ahead and build a model or use this as a threshold to kind of decision on the customers, right? Going forward, if more customers fail or greater than, that's where, yes, the profitability is impacted. But generally, when the decisioning happens, they usually look at your past data and decide what kind of optimum cutoffs are. So they're okay with some defaults. Does that answer your question?
Thank you for that, sir.
Sure.
So there is one question in the chat, that if you can share how the credit rating landscape has changed over a period with the introduction of analytics in this field, and how you look at its future.
Well, I think it has changed tremendously, right? Two ways it has changed. Two things that has happened is, the time it takes, right? I have seen from my past experiences that earlier to process any application takes around 2 weeks, 3 weeks. SBI takes 1 month, right? But with this credit ratings and with the introduction of analytics, what has happened is there is a lot of models which will quickly decide. Because earlier what happened is that the guy at the front desk, the relationship manager, will gauge at a lot of information. He will take time. There is a lot of inherent bias, because obviously he's a human being, so there's a lot of bias. And since he is a human being, he cannot cross-validate with a lot of data before to understand whether you are credit-worthy or not. So from a credit rating landscape, I think analytics has improved because the process time has improved, one. Second thing is, like we talked before, in terms of default, right? The predictability, the profitability, it has improved. Because with credit ratings, right, you are mostly kind of looking at how the customers is changing. For example, let's look at say for Tata Power. I'll give an example like Tata Power. If you would have followed Moody's rating for it, right? Over time, Moody's has kind of put it on hold. Its rating was deteriorating because they were saying that it had a lot of debt. It had a lot of debt, and its debt to equity ratio was very high. But now they are giving it a better rating because the debt to equity ratio has gone down. This tracking, right? This tracking has happened because the credit ratings have come into picture, the modeling has come into picture, and it's very consistent. So Tata Power has been consistently looked at, and its rating improved because you have this analytics come into picture. So I think it's a positive bet, and it improves the efficiency and it improves the predictability. So I think it's a good step.
So, sir, we have another question. So, how the modeling changed in COVID times, and how the analytics helped the fintech to cope up during these times?
This is an interesting bit because I think at this point of time, COVID, right? The impact of COVID is still not clear. Could be tech savvy and also. Sorry, it's more on. Sorry, is this the question that we're talking about? Harsh's question, right? So it's about.
No, sir, Piyush's question.
Okay. Sorry, if you can just repeat the question again.
The modeling has changed in the COVID. How the modeling has changed in the COVID times, and how the analytics helped the fintech to cope during these times.
How has the COVID changed? I would be in a better position to answer that next year. Right now, what we're trying to do is that we are trying to generate those scenarios. Basically, what we're trying to do is we're trying to look at the impacts of COVID, right? The impacts of COVID will be looked at this year because see, last year you still have people with money, still they had, but gradually with COVID, right, the impact would have felt in the last quarter of last year, and more so a little because default data, right? Those datas, they are always lagged. They don't come in immediately, right? You don't immediate go into default. You go gradually. So my point is that the impact of COVID in terms of modeling landscape will be looked at this year. The way I look at it is that instead of changing your model anyway, what people will start doing is like the 2008 crisis, they will take it as a downturn scenario. They will try to kind of use this as a parameter to override the model, right? To overlay the model. Like it will have an additional parameter over and above the model to kind of make it a little more conservative. The way I look at it, I don't think you can basically, because variables, right? Suddenly they might give you very confusing signals because of COVID. So, and it's a very short time period. So if you look at it from a purely modeling perspective, right? You guys would have seen there's something called as abnormality in default rate, right? You have, say, a time period of, say, 2019 to 2021 for a modeling. And suddenly for 3 months, your default rate has gone up to 7%, whereas your traditional your default rate is 1%. Should you take the 7% in your modeling? Because it kinds of changes the entire landscape, right? And your variables information will not be steady. So my thought is at this point of time, I don't know how we are going to build those new models, but my thought is that we'll remove this data from the model. We'll build on the traditional model, but use this as a overlay, additional overlay over and above to kind of make it conservative. So that's the thought.
So, looking at the time, so we will take last two questions. So from Harsh, there is a question that can there be an impetus on greater collaboration between the banks and the fintechs, so that the big banks could have a tech-savvy infrastructure, and also it would be less susceptible to risk from the defaults when compared with the fintech startup?
Yeah, the short answer is yes, and that's the way forward. I think there will be a lot of collaboration. There is an impetus there because, like you mentioned and like I talked about before, the infrastructure has to be more nimbler, more smoother, and that's where the fintechs would help definitely. Susceptible to risk from defaults, I don't think the default will ever cease to exist. You will always have defaults, but perhaps your modeling techniques being more efficient in terms of predicting, you might have better genies, you might have better chances of getting better models, but not completely erase the defaults. That would never happen. You cannot completely erase the need of Moody. That's what I'm trying to say.
Rightly said, sir. So we'll have a last question. We have a question from Shwetab. Shwetab, you can go ahead.
Yeah, thank you for the session, sir. Sir, I wanted to ask, like, how these methodologies, team modeling team and this validating team, they collaborate with each other to make the process more efficient, because the efficiency of the result does relies on that. how much they collaborate?
I think the validation and the modeling team are frenemies, if I may say that. They're frenemies because you don't if they collaborate too much, right? Then the validation will agree to everything that the modeling says, and there's nothing to kind of challenge. And the regulators will come back to the validators and ask you, why did you accept the model as it is? So they are frenemies in the sense that they will help the model improve by challenging the methodologies that modeling team has. The methodology team and modeling team definitely are on the same side because basically one implements the other's thoughts in terms of the underlying model methodology. So they do collaborate, but validation team will always act as an independent function and kind of challenge the modeling methodology. So that's how it works.
Thank you, sir. So we'll formally conclude the session here. So the talk you gave us gave a good understanding of the modeling stages and how the different teams are involved in engaging to have a success story for the entire organization. I personally am better able to synergize my statistical understanding with the problem statements of the fintech and how it plays a role in the finance domain.
Sure.
Thank you so much.
Thank you so much. Thank you, everyone.
Thank you.
Thank you, sir.